I think great investment decisions are made in very uncertain times.
The geopolitics thesis we had at the start of the year is clearly playing out, and probably even faster and to some extent worse than we expected, with just countries losing trust with each other and more wars being ongoing.
It's difficult to really speculate how long prices will be higher. We had a ceasefire declared yesterday and a really good day in the market.
If oil stays longer and goes higher, it's obviously negative for that part of the portfolio. So that was one of the ways we reduced exposure somewhat and added hedges to the fund.
Stages are set for some kind of agreement. It may take longer than we anticipate, but it is very clear that the US do want out of this war.
Hi everyone, and welcome to our first quarter 2026 newsletter. The year started off nicely with both the JSE and global equity markets showing strong performance during Jan and Feb. And then things rapidly reversed post the start of the Iran war, with the JSE ending the month of March down more than 10%. As we wrote in our year-end letter, we came into the year very optimistic about the businesses we own. The outlook for the South African economy was bright. We believe that store of value assets would be very well positioned, and we were most excited about the rapid developments we were seeing in AI. During the month of March, share prices across most things we own sold off as investors sold assets to raise cash. This is typical for these periods of panic in markets, where investors first sell everything, go to cash, and then once shares stabilize, they start trading on the individual fundamentals again. At the end of the first quarter, the high growth fund was down 3.5% for the year, whilst pleasing that pure hedge held up very well, was only down minus 0.2% in a very difficult quarter. We'll look to cover how the war and the events around that has impacted the three major themes we've got in the portfolio, and also give you some outlook for the year ahead. So David, let's start by looking at how this war has impacted the outlook for the South African economy and the companies we own here.
Well, I think as all our investors know, we were extremely positive on the outlook of South Africa for this year. Certainly we believed that the precious metal boost that we were going to get both through gold and the platinum group metals was very positive this year. Unfortunately, what this US-Iranian war has done for us is effectively spiked the price of crude oil by more than 100%. So it's more than doubled. And I think even worse than that, what they call the crack spreads, which is effectively the margin between crude products and final products, has also moved up to a record high. The diesel crack at the moment, I think, is around $45. So what that really means is the price of actually petrol and diesel has moved up even more than the price of crude oil. And given that South Africa is a oil importing country, and really we only have Sasol to speak of that manufactures oil from coal locally, which is roughly around just over 20% of our consumption. We have two other local refineries that both account for roughly 10% of that. So roughly 60% of our liquid fuel product is actually fully imported. And again, this is a very significant effect on the balance of payments. In fact, as we sit right now at spot, it's a delta of around 150 billion on an annualized basis, which basically eats into both the PGM and the gold surplus that we were looking for. And again, with this sort of a price shock, it is extremely negative for South Africa. It obviously is going to feed into food prices, feed into logistic prices, and again, even inflation. So even in the South African scenario, where literally 2 months ago we were looking for continued interest rate cuts, we now have a potential for some interest rate hikes in this country, given that the effect that this oil price spike is going to have on local inflation. So again, a scenario that's changed very quickly for South Africa. We're obviously monitoring the situation as it goes. What have we done with the portfolio? Obviously, we have dropped our South African equity component quite significantly. And where we have stayed in South African shares, it's very much been in resilient shares where we feel have the pricing power to recover any input cost push from petrol prices and associated costs. We're looking for the better management teams as well as resilient balance sheets. So, again, it's difficult to really speculate how long prices will be higher. We had a ceasefire declared yesterday and a really good day in the market. It now looks like, negotiations are going to be pretty protracted and go on for a fair amount of time. But certainly in our view, a higher for longer oil price is definitely going to be certainly in 2026. And I think it's something that we needed to recalibrate our portfolio to, which I think we have done now. And obviously going forward, we'll look at how the war resolves and how quickly we can get back to a normalized basis on fuel prices and where they eventually settle.
Yeah, this is probably the area where we've made the most active changes during the quarter. As Dave said, we cut some positions in SA. Looks, some companies actually marginally benefit from this. A business like ShopRite, where food inflation is typically good for food retailers, will probably do quite well in this environment, despite having to pass on fuel price increases. And additionally, we put in a small long position in Brent crude oil as a direct hedge to the South African portfolio, where if oil stays longer and goes higher, it's obviously negative for that part of the portfolio. So that was one of the ways we reduced exposure somewhat and added hedges to the fund. If we look then at our positions in gold and platinum miners, it's actually been a nice positive for the first quarter as that trend continued to play out. Specifically during the month of March, these things pulled back rapidly. So it ended the quarter well, but obviously during March gave back some of the Jan Feb gains. I mean, Dave, maybe give me some of your current views on the outlook for store of value assets.
Yeah, well, certainly on gold, I mean, we feel with what is happening in the world right now does absolutely reinforce the investment case for store of value assets. There's no doubt with turmoil like it's happening right now, and I think will continue to happen. I think even once we settle down in the Iranian-US situation, we certainly believe that the store of value thesis will very much hold up, and we think the reasons to be in it are probably stronger now than they've ever been. So it is one of the areas where we have held our positioning as it was sort of before the war. Tactically, we've made a few adjustments here and there, but it is something that we still believe in the medium term is actually going to pay off good dividends. I think that there's, it's quite interesting on the announcement of the truce yesterday, gold actually went up. So I think there is a few anomalies on how it is trading at the moment, and there's no doubt when the war started, there was quite a big drawdown in gold, but I think that really just is a result of a speculative position that built up in gold. Obviously, with it became a mainline theme. And I think it needed to sort of wash out some of that speculation and some of that, high risk type of investing. But we really do think that gold going forward now is going to be a pretty good story for us. And we have what I would call an appropriate position in the fund.
Mm. I think it's also a part of the portfolio we will monitor closely. For example, in Jan and Feb, we bought some put options on gold to actually hedge potential drawdowns, even though we didn't think it would be as severe as clearly happened with the Iran war. But as David said, the geopolitics thesis we had at the start of the year is clearly playing out, and probably even faster and to some extent worse than we expected, with just countries losing trust with each other and more wars being ongoing. And it does feel to us that it's highly likely over the medium term to be a favorable environment for gold. I mean, the area, I think, and specifically in the first quarter, where the market and share prices specifically has most diverged from fundamentals and the trends happening in the sector is AI. If we look at the progress in the quarter, it's just been absolutely immense. We really feel like somewhere around December or last year or January this year, we entered the singularity phase of AI improvement, and we really define that as a level where the models are now good enough that the AI labs like Anthropic and OpenAI are rapidly improving their own new models by using the existing models to write a lot of their code. So specifically on coding, we believe certainly in the last quarter, the coding engines provided by these AI companies have now surpassed the level of the very best humans in the world, and all the best developers and coders at these AI labs exclusively now use coding agents for code, and they review it and they give it the direction to go in, but they're not writing code anymore. And that's just been an immense change in how the world looks and works. And we think it's just going to keep going. Like recently in the last week or two, Anthropic has come out with their new model called Mythos. The model is so good that they believe it can find many security vulnerabilities in existing software out there. It's actually so powerful they've restricted release and are first releasing it to security companies to try to fix software flaws before they release it to the public. So this shows you the level of power these models have gotten to, and it's going to be really exciting when they can release these models, hopefully in a month or two, to people and companies and around the world to solve lots of different problems and accelerate the speed of working. So we are extremely excited about the prospects for these businesses we own, both beneficiaries of AI, like businesses like Amazon, Meta, Google, and then also semiconductor companies, where we think the demands for semiconductors will just be off the charts for the next few years as people rush to implement AI in their businesses and use it in their personal lives. So I think at the point we are right now, it's very difficult to forecast where markets will go in the short term. I mean, Dave, the outlook is largely binary, right?
Correct. I mean, there's obviously a high road, medium road, and a low road scenario that are going to play out over the next few weeks. So I mean, I don't know how many Straits of Hormuz calls I've had, but it certainly goes into about 30 or 40 over the last 4 or 5 weeks. So I am an expert on that if you want to ask me something. But I mean, it does look like certainly a very difficult situation to get out of. But there does seem very clearly that Donald Trump is looking for any off-ramp he can. There's no doubt it has hurt him at the polls. So I do think that all stages are set for some kind of agreement. It may take longer than we anticipate, but it is very, very clear that the US do want out of this war and don't want boots on the ground and don't want things to escalate any further than they have right now. So we certainly feel that perhaps we are through the worst of it, but it is going to be data dependent, and we continue to watch the news, we continue to watch live feeds to see where things are, and are ready to act appropriately once that information does come out.
Yeah, I think things can move very, very quickly. We've already seen a rapid bounce backs in markets in the first few weeks of April. I think what we're faced with is we're probably some of the most excited we've been in a long time about the prospect for the shares in the fund over the next 18 months. But saying that, we also have to manage the short-term risks around this war to make sure the funds are protected if the bad case scenario plays out, but make sure we're well positioned and that our company fundamentals will play out and benefit the portfolio if things settle. So we're trying to strike that fine balance, and I think we're fairly well positioned right now, despite not knowing which way things will play out.
Yeah. I think, as you know, nobody likes drawdowns, and we particularly don't like drawdowns in our funds. It hurts us. It hurts us very significantly, and we do feel it. But I think, as Jacques reminded me a couple of weeks ago, it is in these opportunities where there is market dislocations that generally we find some of our best ideas. And we look back after periods of significant drawdowns in the market, and we look back and we see, wow, look at, we really did some wonderful buying and put in some wonderful companies in these sort of times when markets were dislocated. And that payoff is generally seen in the couple of quarters after that. So I think great investment decisions are made in very uncertain times, and hopefully when we come out of this scenario, we can look forward to continued good returns for our investors.
Right. Thank you, everyone, and enjoy the holidays in April.
Thanks.